All right, good afternoon. My name is Greg Smith, and we're holding the third of a three-part webinar series. For those who have been joining us, as you'll recall, back on May 12th, we had a webinar on getting your financial house in order. And during this economic crisis with the coronavirus, it's more important now than ever to make sure that we're organized and we're taking advantage of every opportunity for our business and making sure that we're not making dumb mistakes by not being organized. That was our webinar on May 12th. And if you'll recall, there were three key principles we talked about from Dr. Stephen Covey's 7 Habits of Highly Effective People. The first habit we talked about was being proactive as an entrepreneur. Then we talked about putting first things first, making sure our actions are in line with where we want our business to go. And the third habit of a highly effective entrepreneur or person is beginning with the end in mind, knowing where we want to be in our business. And so that was webinar number 1 on May 12th. Then we moved to our second webinar in the series, Preparing and Managing a Cash Flow Budget. And we talked about that successful entrepreneurs are able to take complex issues and break them down to the most simple elements. And in the case of budgeting, it's budgeting to the day, knowing what our daily costs are and knowing what we can anticipate in daily income. We talked about knowing how money flows into the business and then how it flows out. We also talked about by just making incremental changes within our expenses that they could add up to a whole lot of money. Remember, we talked about if we could just save $1 a day over 365 days, that turns into a nice little pile of cash that can be used for other purposes within the business. And you'll recall we talked about that there's really only 2 ways for a business to generate more net income. And that's either bring in additional revenue or to reduce our expenses. And so last week we talked about preparing and managing the cash flow budget. Well, this week we're going to talk about financial statements. What are they? How do we prepare them? And what do they mean? And so today we're going to talk about the balance sheet and the profit and loss statement. Now I want to be really, really clear. There's lots of ways to put these together. And in the interest of our short amount of time, we're going to do just a cash basis of accounting, not accrual, cash basis. And in addition, we're going to be just talking about principles and how to put them together. And so keep in mind that financial statements can be much, much, much more complicated than what you're going to see today. But again, we just want you to see what are they and how you put them together and what they mean to your business. So let's start off today with the balance sheet. In a balance sheet, there's 3 primary categories we need to think about. The first is assets. What is an asset? An asset is something you own. It's something tangible. In this case, or it could be intangible, but it's something you own. In this case, for our example, cash, accounts receivable, inventory, equipment, and real estate are the assets that we're listing at. But an asset can be more than that. This pen is an asset. That car driving by out there is an asset. The building in which we're functioning in is an asset. One of the things I hope you tune in on are these assets are listed in order of what's called liquidity. How quick can this asset be turned to cash? Well, cash can be turned into cash pretty darn quick. Accounts receivable tend to be the next most liquid asset. Then inventory and equipment, and then that asset that typically is the least liquid is real estate. So in our example, in our balance sheet, we listed our assets out in terms of liquidity, cash, then accounts receivable, inventory, equipment, and real estate. In our example today, we just assigned numbers here. Again, they mean nothing. We just want to show you how to do this. In this case, our assets total $3,800. We then look at the liabilities associated with these assets. So these are the things we own. These are the things we owe. And typically, there's two ways to do it. You can list your liabilities out individually, which really brings clarity to you and to who's looking at them. But in this case, we're just bundling them up, and we're looking at our current liabilities and our long-term liabilities. What are current liabilities? Those are the liabilities you have that must be paid within the next 12 months. So let's look at this. If we borrowed money for inventory, chances are any money we borrowed for inventory, maybe an accounts payable, maybe a draw off a line of credit, is going to be included in our current liabilities. Long-term liabilities are those obligations we have that need to be paid more than 12 months from now. Perhaps we purchased a piece of equipment on a 5-year loan. Perhaps we took out a loan to purchase office equipment, but we're going to buy it over 2 years. Okay? Real estate definitely is a long-term obligation, and so it gets placed down in long-term liabilities. So again, liabilities typically fall into two categories: those that are current liabilities and those that are long-term. And in this case, we assigned a number of $3,000. So one of the things we're going to talk about today, I'm going to bring over my handy-dandy easel. Patrick, I'll need your help in a moment, is assets minus liabilities equal your net worth, or a term that's called equity. Assets minus liabilities equal your net worth or your equity. And Patrick, this little stand over here needs to be tightened up a little bit for me.
Okay.
So our assets of $3,800 minus our liabilities of $3,000 give us a net worth of $800. So let me share with you. We can have all the assets in the world. This number could be 3 million or 300 million. But really, to determine our net worth, we have to compare what we have versus what we owe on it. Does that make sense? Let's move on. Again, we talked about listing your assets in order, and your liabilities, once again, are listed in order, current and long-term. Now, one of the things I want to talk about is a ratio. This is a ratio that lenders use when they're looking at whether they want to loan money to your business. And it's a ratio that you should always be thinking about. And it's really simple. No matter what level of math skill you have, this is something we can do. It's called the debt to asset ratio. And in this case, what you do is you take your $3,000, in our scenario, again, it's make-believe, and we divide it by 3,800, okay? And so when you take 3,000 and you divide it by 3,800, you come up with a ratio of 79%. Now, the further we can get away from 100%, the better. If this number was 3,800 and this number was 3,800, that ratio is going to be 1. And that's not good. That means for every dollar of liability, it's tied to an asset. On the other hand, if this was, instead of 3,000, let's say $1,500, and we divided it by 3,800, That gives us a debt to asset ratio of 0.39. Again, moving away from 100%, and that's positive. So one of the things you want to be working on as a business owner is reducing your liabilities while increasing your assets. Because when you increase your assets and reduce your liabilities, your debt to asset ratio improves, and that makes you more eligible for borrowing. By the way, do we remember what the 6 C's of borrowing are? We talked about this in week 1 and week 2. The first thing lenders look at is your character. They then look at your credit. Do you pay your obligations on time and as agreed? Do you not have excessive debt? They then look at your cash flow. Remember we talked about cash flow, how money flows in and how it flows out? We spent an hour last week on that. By the way, if at any point in time folks need help on putting together a cash flow budget, give me a call. I'm more than willing to sit down with you. We'll work through it, and we'll help you better understand how your business is managing its daily obligations. They then, lenders, character, credit, cash flow, they then look at your collateral. And part of that collateral is measuring your debt to assets. They want to know, do you already have too much debt compared to the assets that you own? And if the answer is yes, then it makes it hard to borrow additional money or to borrow money at all. In addition, if that debt to asset ratio, again, is kind of skewed in the wrong direction, it has an impact on your cash flow, because that means more and more of the cash you bring in is having to pay that dreaded interest expense. And then it's contribution and community. Let's move on. We talked about that assets minus liabilities give you your net worth. At the same time, you could reverse that formula, and your net worth plus your liabilities should equal your assets. Let's move to the profit and loss. The profit and loss is an evolving financial document. This is a snapshot in time. This says, on this date in May of the year 2020, this is what I own, this is what I owe, and here's my net worth. On the profit and loss, it's to this date in time, as of. And so, in our case, we once again logically placed categories according to generally accepted accounting principles. Now, I want you to keep in mind, for any business, there's going to be differences. I just want to share the principle of what goes into a profit and loss. The first line item is your gross income. By the way, what does gross mean? There's several definitions, but in the world of accounting, gross means that there's potential obligations tied to it or deductions that will come out. So when you see gross income, you need to automatically assume that expenses are going to be tied to it. And so in this case, we looked at cost of goods sold and any returns that may occur, especially say in the restaurant business or in the clothing industry, retail. Customers return items all the time. Well, when they return it, that needs to come off of your sales. So you may have earned that money, but when the customer returns it, you have to subtract it back out. So in our case, we had a gross income of $2,000. And let's just pretend in this case we're running a retail business, just for our example. The cost of our clothing was $500. Customers didn't quite like what they ordered when they got it home, so they returned it. And so now our gross income is $1,400. Notice I'm still using the term gross, because in order to operate our retail business, additional expenses are going to need to come out. Labor, mortgage, utilities, and I just put et cetera here. There could be 1,000 other expenses that would be tied to this business, but in the interest of time, I'll just use et cetera. 500 plus 300 plus the 100 plus the 100 gives us total expenses of $1,000. We take our gross income minus our expenses. In this case, I've just made this up. We may have other expenses that are completely unassociated with this. What might be an example of another expense? Well, what happens if last year you forgot to pay your income taxes or your payroll taxes and now you're having to make it up? That's an example of an other expense that needs to be met. In this case, we just said 100. So we started off the year, let's say, with 2,000 in gross income, or maybe this is a monthly profit and loss, or maybe it's a daily profit and loss. But in this period, in this example, we earned $2,000. It cost us $50 to sell the commodities that we had. We had $100 worth of returns for gross income of $1,400. Again, we listed out our expenses. So $1,400 minus 1,000 minus 100 equals the $300. Does that make sense? It's pretty simple. Income minus the expenses give us our profit. Now, one of the things I want to talk about is the power of compounding interest and how it relates to your financial statements. A little more over.
Keep going, about halfway.
Halfway, are we there? You know what, Patrick? I'm going to move it right over here.
Oh, that's right there.
Is that all right?
Go back that way.
Go back a little.
Perfect.
All right. I want to talk about the power of compounding interest and what that means to your financial statement. Okay? One, interest is a liability. Remember we talked about that? It's an obligation that's going to have to be met when you use somebody else's money to acquire your assets. Think about what I just said there. Interest is the expense or the cost of using someone else's money to acquire the asset. In addition, interest plays out as an expense to your business. And so I want you to understand what borrowing means to your company. It may help you get inventory. Borrowing may help you get equipment. Borrowing most definitely can help you obtain real estate, but it comes at a cost. And I want to share this example. I want to share this example with you. I'm going to take the company off here because I don't want to incriminate a company. See this beautiful camper trailer? It's beautiful. It's absolutely beautiful. And according to this, it costs $36,500. $36,500. Well, I want to do a little math, and I want to show you the power of compounding interest and how it can benefit your company, and at the same time, the same concept of the power of compounding interest can be a huge anchor around your neck. Let's take that $36,500 and let's assume we borrow that money for 10 years at 6% interest. We really want to have this. And by the way, this could be a backhoe or this could be anything else. Interest doesn't care. It's the cost of using money. And so that $36,500, if we finance it at 6% for 10 years, is going to result in a monthly payment of $405.22. Every month until that loan is paid off, you as a business owner, you as a consumer, borrowing money to make that purchase is going to cost you $405.22. The good news is that once in a while you want to miss a payment, the bank's okay with that. No, it's not. It's not. Every month, this is the cost of making that purchase. Get used to that sound. Well, that $405.22 over 10 years at 6% interest results in an interest cost of $12,126, which means that borrowing of $36,500 actually cost you $48,626. You were able to use somebody else's money, $36,500, to get yourself an asset, but it created a liability for you, and every month it's an expense that must be paid. Now, the power of compounding interest just played in favor of the bank. Let's flip it upside down. What if you took that payment of $405 that you were going to use to pay off that piece of equipment? And what if you decided, rather than doing that, you were going to save that money? Maybe that piece of equipment wasn't so important after all, which, by the way, I don't want to judge, because some equipment you have to have if you're going to have income. But what happens rather than borrowing that money? What if you saved up to make the purchase, or you just didn't make the purchase after all? And let's just say on that $405.22 payment, rather than paying it to the bank, you paid it to yourself and you invested it in an equity fund in the stock market. What would that be? $405.22 every month for 10 years, earning the average rate of return of 6%. Rather than giving it to the banks for 6, you put it in the stock market and you gain 6. And I do know that sometimes the market's down, but the market is also up. And so over that 10 years, we gained 6%. Do you know what that turns into? That results in an investment to you of $65,837. So rather than giving the bank $48,626 for the toy, for the piece of equipment, for that asset you may need, instead you turn that asset into cash of $65,837. Well, if you take the interest expense of $12,126 and then you add in the savings that you had just earned of $65,837, that results in $77,963 difference. Do you see that? Study the power of compounding interest. It is absolutely vital for the success of your company, and it plays directly onto your balance sheet, and it plays directly onto your profit and loss statement. Last thing we're going to talk about today, very briefly, is understanding tax implications. Keep in mind, this $300, that $300 you're going to have to pay income tax on. Both Uncle Sam and the Oregon Department of Revenue are going to want a percentage of that $300. And so it's really important to understand the tax implications of how your business operates. That means it's really important for you to associate with professionals who can help you understand that conversation. Find yourself a good CPA. Find yourself a good bookkeeper. Feel free to come visit with me. While I'm in no way a CPA, I've got a little bit of a background to where we can at least sit down and talk about the decisions you make in your business and what they mean to that bottom line. All right. So this is going to be wrapping up the last of our 3-part webinar. Today's webinar was a little shorter than the week before, but again, I hope you've been able to benefit from preparing and managing a cash flow budget, getting your financial house in order, and now understanding just a small part, what is a balance sheet and what is a profit and loss for a cash-based business. By the way, as an aside, this is probably pretty relatively easy for some folks, but for others it isn't. For those folks who really know their craft or their skill, but this just isn't their bag, come talk to me. Let's figure out how to work through that. Let's help get the professional you need who can help you understand this information. And finally, remember we talked about that debt to asset ratio. We can have all the assets we want, but if we have liabilities encumbering it, that ratio is not going to look very good, and it's going to hamper our ability to work in the future. This has been Greg Smith.
We got one question, Greg.
Yeah, we have a question. Patrick, give me the question.
How is COG determined?
So COG is the cost of goods sold. And for every business, that's a little bit different. But typically, these are the expenses that go into making the sale. So in retail, the cost of goods sold might be the clothing. It might be the tennis shoes. It's those items that help make the sale. And again, for every business that gets a little different, or is a little bit different. And so if you have a direct question on that, just give me a call again. We can sit down and based upon the type of company you have, we'll make sure that definition is shared correctly. All right, this has been Greg Smith. We hope you appreciate or have gained just a nugget of information. Again, keep in mind, this is just an example. We just wanted to share a few concepts with folks. And again, it's for a cash basis business. And again, I'm not a CPA. I always recommend you reach out to your CPA or give me a call and I'll help you find a good professional. Stay in touch, stay safe, and watch for our next webinar, which will be coming shortly. Have a great day.